Year-on-year inflation for September, 28.3%. Yes, it's a function of higher food prices, but why such a significant impact? I mean, food inflation has been the story of most countries, including Uganda, but why this kind of impact?
Part of the increase in food actually is the exchange rate. The exchange rate on annual basis depreciated by around 25%. So when we talk about food inflation, it has both what we call food crop, which are these the fresh vegetables, etc., and also the processed foodstuffs like rice, like maize, like bread, and like sugar. Sugar has the highest increase of 138% on year-to-year basis. So some of these have, you have to see them in terms of exchange rate depreciation of on an annual basis of 25%.
All right, so food is one component, but in general, core inflation is rising, and I'm talking about inflation excluding food, fuel prices, and also electricity. The general hike in prices across the board in Uganda, is it also a function of this weakened shilling?
Well, yeah, that's true. That's what I'm trying to say, because if you see the core inflation, you also have fuel. For example, fuel price increases are increased by 39% on an annual basis. So, and that one is also feeding into the core inflation.
All right, so what measures are being taken to curb this weakened shilling? I know that you've looked at a new sort of an interest rate regime and also inflation targeting, but so far it doesn't seem to be working.
Well, Lerato, monetary policy works with a lag, and you know very well that in most countries the lag even can go to 2 years. So in our case, actually, we estimated the lag to be between 6 and 12 months. So we started tightening, a couple of months ago. 2012, we should start seeing prices decline. But again, you are right, we still have a problem with current the exchange rate driven by weak balance of payments. And, since our exports go to Europe, and you know what's going on in the European market, basically, although we export most of the agricultural commodities, they go to Europe, and we import from China and India. So the weak demand from the European market means that our exports are not really responsive to the exchange rate depreciation, yet we still have a strong demand from imports coming from India and China. So we have to that exchange rate really correct the market,
right?
But also at the cost that this is feeding into inflation. So all we can do is again tighten further.
Okay, so you're giving us an indication of what we're likely to see next week when members of the Monetary Policy Committee meet. We've already seen 2 hikes in the last 2 sessions, so that's probably what we're going to see, the CBR being raised beyond 16%.
Oh, yeah, that's most likely, because currently with the hike in core inflation, we are likely to see an increase in the CBR rate.
And just in terms of consumers' ability to cope, because effectively it means the cost of borrowing rises. We know Uganda's had a huge problem in terms of getting credit flow. So you've also got to consider the growth priorities of the country under these conditions.
Well, you are right. Initially, when we are increasing the CBR from 14 to 13, those are some of the considerations we are looking at. But given the momentum again of continued, because by now we had projected that probably prices would, relatively be stable or start declining. But with the momentum of the increase, it looks as if we still have a room in terms of tightening further.
All right. Now, interestingly, I know that the Bank of Uganda's targeted for the medium term 5% inflation. That seems completely unrealistic now that we're talking double-digit inflation. But what sort of things do you think are going to help mitigate inflation going forward?
As I said, if we can, if really we can hold on exchange rate behavior, and I think given the outlook, we are likely to start seeing a substitution of imports for oil that go into the summer generation, summer power generation declining next year. So that one will start washing off some of the imported demand from for oil. So that will start helping. But basically, I think the drive and some of the structural measures in terms of agriculture being advanced by the ministries, I think should be able to help us stimulate exports into in the regional market, given the food scarcity in the region, and therefore probably helping us to boost exports.
Right.
And we're likely to see that actually imports decline in the coming year.
Talking about some of those structural measures in agriculture, just give us a sense of fiscal policy going forward and basic strategic imperatives for the government, because we know that agriculture is 90% of the Ugandan economy. It is the largest, or 90% of the foreign exchange earnings for the Ugandan economy. So you should actually be benefiting from higher prices. But because of the exchange rate, obviously, you've explained to us some of the shortcomings. Oil, hopefully coming on stream, should create another avenue of forex earnings. But what else is being done to really address the dependency on agriculture and hence the vulnerability when we see this kind of market volatility?
I think one of the most important measures being undertaken is actually processing the foodstuffs. Putting on storage facilities in the rural areas instead of the farmers selling the food, whatever they get from the market, from the garden at any given time. And so if you have community storage facilities, implying that now the farmers can be able to, to take measures to sell at a particular time rather than just harvesting and selling at any given time, I think that is really one step forward. And also the encouraging of processing most of the foodstuffs. Because, for example, we're talking about beans. Beans in Uganda, most of them are eaten when they are still fresh. People don't wait for them to dry, and therefore, it is. But now, I think the storage facilities, the processing, preservation of the foodstuffs should be able to help some of the food prices.
Okay.